Hello and welcome back to Essentially Explained, and in today's video we're just having a short discussion about the minimum wage, more specifically traditional analysis, and basically critiquing it. We might do a more in-depth video about minimum wage and sort of its merits and disadvantages, but today we'll just be talking about why traditional analysis might not hold up for a couple of reasons economically. So traditional analysis basically assumes there will be a deadweight loss if you increase or introduce a minimum wage. And of course the model assumes that the minimum wage will be higher or a higher price point than the former sort of equilibrium price. And essentially this deadweight loss is generated because the employer obviously suffers from higher costs through having to pay higher wages. Also could be because some workers are made redundant as those businesses and those employers even try to offset those costs. But there's about 3 reasons why this line of reasoning might not hold up, and they are work effort, elasticity, and monopsonies. So first we'll have a quick discussion about work effort. Now, for all these reasons, we're going to be assuming that, for work effort, that if you're increasing the wage of those workers, their work effort will go up, and as a result, their productivity will go up. And since, let's say, in a factory, if you've got more productive workers, you're making more stuff which you can sell and turn into revenue, and that revenue can offset your higher costs. Obviously, there's arguments against these. Obviously, a higher wage doesn't always incentivize more work or a higher work effort. But for the purposes of this video, we'll just assume that it will, more for time's sake than anything else. As I said, we can do a longer video talking about the sort of counterpoints and what have you. The second reason is elasticity. So obviously the demand for labour can be elastic, and in which case this reason doesn't really hold up. But assuming that it is inelastic, then the negative impact of an increase in the minimum wage or introducing a minimum wage would be very small, because even if your demand for labour, proportionally the hit on the demand for labour would be much smaller than the increase in wages that would benefit workers, and also on a more macro level the wider economy, because they've got more income or disposable income even to spend, or even if it's just to meet their basic needs, then you've got less people relying on welfare benefits or having to seek help from the government because they're not unable to meet their own needs because of the low wages. The third reason is monopsonies. So you've got monopolies where you've got one firm which controls the market, and basically is the one seller within that market. But monopsonies are essentially the sole buyer within a market. So you can have a market where you've got one large employer, or even if you have a market with multiple large buyers with a lot of market power, then in those imperfectly competitive markets for labour, those firms have the power to push down the wages for unskilled workers below the competitive market equilibrium. So essentially those workers are somewhat exploited because their wages are lower than the market equilibrium price. But because those firms have so much power, there's no competition to essentially take those workers away by offering a more fair, more competitive wage. So by introducing a minimum wage in those imperfectly competitive markets, you won't suffer that problem because they can't physically push those wages below that minimum wage. They can't push it below it, which is obviously useful for the workers because they can actually afford the necessities and to sort of live. And finally, we'll just have a quick discussion about minimum wage as a policy before we go. So, essentially, the minimum wage as an anti-poverty policy relies on two beliefs, two assumptions even, you could argue. So, raising the minimum wage will increase the income of poor families is the first belief. As I said, the model stipulates or assumes that the minimum wage is above the market equilibrium price or wage. Otherwise, what's the point in introducing it? And the second belief is increasing the minimum wage imposes little or no public or social costs. And again, there are counter arguments to this, which we'll cover in another video. But those are essentially the two assumptions you have concerning that policy. So yeah, this has just been a quick video on a traditional analysis, a couple criticisms of the traditional analysis, and a little bit on the beliefs, or the two beliefs of the policy of minimum wage. So hopefully we should get a regular upload schedule. Hopefully we should be able to start putting these videos out more regularly. But yes, please like, subscribe, and until next time, I'll see you later.